Okay, so welcome everybody here to the REI Club. And today's guest speaker, I'll let him introduce himself. Scott.
Okay. My name is Scott Maurma with Advanta IRA. I'm going to be talking today about real estate investing with retirement funds. And I can kind of just jump forward and give you just a quick bio on myself. I'm the Director of Business Development for a company called Advanta IRA. We are a self-directed retirement plan administrator. My educational background, I am a licensed attorney. I don't do any legal work for Advanta clients, but it certainly gives me maybe a deeper understanding of some of the things we do. I'm also a certified IRA services professional, so I know kind of a lot of the ins and outs and the background of IRAs, distributions, contribution, all those rules, et cetera. But not really going to focus much on that today, focus more on the alternative assets that you can hold inside the IRA.
If you had any information also about rolling over retirement plans that are in larger corporations to self-directed IRAs, I'd love to hear any information you have about 401k or other types of investment vehicles that you can roll over.
Yeah, we do. I do have that as part of the presentation. So did you want me just to go ahead and continue going then?
Yeah, why don't you?
Okay. Sure. So again, a little bit of background on myself. I've been with the company since 2006. I've started that at the height of the real estate boom back in the mid 2000s. Helped a lot of people initially with the process of establishing an account, but then going through the investment process of buying real estate in 2006, and then even into 2008 and 2009. When people were taking advantage of the foreclosures and the short sales. So I worked a lot from that perspective. I've spent more of my time the last several years, though, focusing on the business development and education side of our business. That's really how we try to grow our company, is really just providing educational events like the one that Daniel invited me to speak to today. So my contact information is here on this slide. I can certainly share it again at the end. I'm more than happy at any time to answer questions people may have on different things related specifically to what you have as an investment, as opposed to kind of general information I'm giving today. But quick disclaimer, kind of things that we don't do at Advanta. We don't give any legal, tax, or investment advice. Now we'll talk about some legal issues, essentially talk about some tax issues as well when it comes to IRAs. But we don't give advice from that perspective, and we don't endorse any products, any particular investment. And we're also not affiliated with any other company. So we do have people who come on as guests on our own webinars from time to time to talk about different things in the industry, but they are purely guests from an educational perspective. That's, again, our role. What we do is just try to provide the educational content, and they can certainly connect individuals with attorneys or CPAs as well, who can give them a little more guidance when it comes to the investment. So we don't do legal tax advice. We also don't do investment advice. So for someone who's looking at investing in real estate, for instance, in their IRA account, it is up to them to find the property and do their own due diligence on an investment. That's not the role that we hold here at Advanta. Quick background on our company. We've been around for over 15 years. We have over $1 billion in assets under management. And all of our accounts holders get an account manager here, so a little bit better personal service, I guess, is kind of what we try to promote. But the only thing we do, what I'm going to talk about today, is administration of self-directed IRA accounts. We don't have any other, we're not 1031 exchange specialists, we're not financial advisors, we're not selling mutual funds. We simply administer and hold alternative assets inside a self-directed IRA. And what does that mean? And a lot of times I've heard people refer to a self-directed IRA also as a real estate IRA, because the predominant asset that we see people purchase and invest in with their account with us is real estate. So you'll see people call it a real estate IRA as opposed to a self-directed IRA. What both of those terms mean is that the owner of the IRA, whoever, your account, you have complete control over what investments you're making inside of that account. So you're not limited to mutual funds or stocks or other kind of publicly traded assets that a lot of the brokerage firms or banks limit you to what they sell. They're not willing to let you hold real estate in your IRA because it doesn't fit their business model. IRS regulations do allow for quite a variety of different assets that you can purchase. So there can be notes, rentals, rehabs, gold, silver, private placements, real estate, multifamily syndication. The list really does go on and on. It's a lengthy list, but not every custodian will hold every asset. So we fill a niche in the market where people who have monies with Schwab or Fidelity, Smith Barney, Wells Fargo, etc., you can certainly invest in mutual funds and stocks through those accounts, but when you want to take a portion of your retirement funds and diversify it and put it into a real estate project, you're going to have to use someone like Advanta basically to hold that asset, because we're willing to hold and fill that niche in the market. I think over the several years I've been with Advanta, why do people choose to self-direct? People generally are going to fall into one or more of the buckets here on this screen. For some people, it's a tax benefit. When you're making an investment inside of your IRA account, all of the gains from that investment are not taxable to you. So it's either coming back either tax deferred or possibly tax free if you're using a Roth IRA account, which I'll touch on it in just a moment. So from some individuals, they're looking at the investment purely from a I don't want to pay taxes now situation. Let me use my IRA to make that investment and continue to defer the taxes. For others, it's the stock market fatigue. It's the ups and downs of the market. It's trying to people don't feel comfortable trying to predict when should I pull my money out of the market. Is it at its high? Is now the time to get out? Is now the time to get back in? Being able to choose a rental property down the street or invest in a friend's syndication makes much more sense to a lot of people than trying to kind of pinpoint when the right time is to enter or leave the particular stock market. And for a number of individuals, maybe many of you on this call as well, the IRA is simply used because it's another source of capital. So people who are already purchasing the assets that I'm talking about, the rentals, the rehabs, etc., the IRA simply provides you with a different source of capital. So you're looking to acquire your next project. What available funds do I have to use to make that investment? Maybe you don't want to touch your savings account, or don't want to go to a bank again for a loan on the property. So someone will step in and use their IRA, use that old 401k account to actually make that investment. So it's not necessarily even a tax decision, or you're afraid of the stock market. That's where my money is, and that's easy for me to use and make that particular investment. So we have clients, again, fit in multiple buckets. It includes, white collar professionals, people who work for as a janitor for the school board for years, firefighters, public service employees. Doesn't matter. All those people have in common is, again, looking for something a little bit different inside of their retirement portfolio. Now, as far as the types of monies, when we talk about what could go into a self-directed IRA account, sorry, my screen just popped up there for a second. So what types of accounts can be put in a self-directed IRA? Any traditional or Roth IRA funds. So if you're an individual, maybe you have an old 401k that you've already rolled over to a traditional IRA, or you've started one from scratch, same thing with a Roth IRA. They can be self-directed. If you're self-employed or you have a side business where you're able to have a SEP or a SIMPLE IRA, those are accounts specifically for small business owners that simply allow larger contributions each year than does a traditional or Roth. Similarly, we have an individual 401k plan. Again, for self-employed individuals, larger contribution limits than regular IRA accounts. But the other big one, I think, and I think, Danny, you mentioned at the beginning, I'll get into a little more detail about it, are those former employer plans as well. So people who have worked for a company for a number of years, or maybe worked for, like I said, the school board or the city or state, you develop a retirement plan while working for that employer, you're able to roll that money out. Once you leave that employer, you can roll that money into a traditional IRA account and then open up the world of investment opportunities. So those old employer plans are always a great place that people either forget about at times, or just not quite sure what to do with that money. But getting it into a self-directed IRA is going to give them a lot more control over what those funds are used for. Now, the one account that's not on this screen, unfortunately, are current employer plans. So if you're working for an employer now and your retirement funds are tied up in that current employer's plan, they may restrict your ability to move the money out of the account. In many cases, they do. You may be able to move the money if you're over the age of 59 and a half. A lot of times you will then be able to roll over. Sometimes plans are structured, though, where you can take what they call as an in-service rollover. So you're still employed there, so it's in service, but occasionally those plans will allow you to do a rollover to an IRA. So current employer plans, I would say generally speaking, you can't self-direct those. because the employer is not going to allow you to move that money. But you can always check and ask that question. Call up your HR, call up your plan administrator, and say, hey, I'd like to take some of this money, invest it in a self-directed capacity. What ability do I have to do a rollover of those funds? But once you're no longer employed with that particular company or institution, no problem rolling that money out into an IRA. There's no tax consequence whatsoever to move the money. So with the accounts we're talking about, usually we don't see a lot of accounts just simply created here at Advanta where someone puts in that $5,000 or $6,000 a year. It's usually you have money in an existing account, either again with a bank or a brokerage firm, and you're looking to either transfer it or do a direct rollover depending on the other account that it's coming from. So if you're moving from an IRA at Charles Schwab, for instance, it would be a direct transfer from the Schwab IRA to the self-directed IRA. If you're coming from an old employer's plan, you can move money from that old 401k via direct rollover into the self-directed IRA. Both transfers and direct rollovers are tax-free movement of money, and you can do them as often and whenever you'd like. You're allowed to do partial amounts. You do not have to be a full or complete transfer or rollover when you're moving money. And typically that process takes anywhere from a few days to a few weeks, depending on who that other custodian is. So again, you can move money between IRAs. You can from Schwab to Fidelity, Fidelity to Advanta, Advanta to Morgan Stanley, what have you. As long as the money doesn't touch your hands, it's a non-taxable event, and it's an unlimited amount of time that you can actually move those funds around. Now, we talk about the types of assets. Again, self-directed IRAs a lot of times given the name real estate IRA because probably 75% of the assets that are held in a self-directed account are tied to real estate in some form or fashion. It's people investing in single-family homes, so either that's a long-term or short-term rentals or rehabs. Individuals who lend money from their IRA account, they have their IRA act as a private bank and a private lender and receive a note or mortgage as their investment. Mobile homes, parks, tax liens, and multifamily syndications is something else we've seen quite a bit over the last year or two. Multifamily real estate has been exploding in some various areas, and people are definitely getting into those types of investments as well. So I say that our asset, the real estate assets make up 75%. But again, real estate is such a broad term that we see any number of these different investments. Again, the common thread with these is simply that brokerage firms are not going to hold those assets. They're not interested in holding a single-family home inside your IRA account. It doesn't make them money. There's a lot more paperwork involved and a lot more ongoing responsibilities that they would have, which is, again, why they choose not to offer that on their platform. Other alternatives, LLCs, private partnerships, hedge funds, startup companies, cryptocurrency, Forex accounts, private stock. I mean, the list goes on and on. In fact, the IRS says the only things you can't buy in an IRA, you cannot buy life insurance or collectibles, and you cannot invest in an asset that you're going to get a personal benefit from or buy something from yourself. So if you own a piece of rental property now, you cannot sell it to yourself. Or if your IRA goes and buys a piece of real estate, it can't be something you're looking at using for a vacation home or a second home or a primary residence. It's got to be strictly for investment purposes. But there's no master list of all acceptable investments. You simply can't buy life insurance and you can't buy collectibles, and you have to be careful again if you're looking at dealing with yourself. And here's kind of a slide that highlights what I was just talking about. So no life insurance or collectibles, and you can't use your IRA to benefit either yourself or a disqualified person. Or a disqualified people for your IRA account include you as the account owner and your spouse, your parents and grandparents, children and grandchildren, etc. To those individuals, no disqualified person could buy or sell to your IRA. None of those individuals could lend to or receive a loan from your IRA. None of those individuals could live in a property or vacation in it. Even if they're paying rent, it would still be prohibited. Whether they live free or pay rent, it's still a prohibited transaction. So again, the IRS has some restrictions when it comes down to simply who the disqualified persons are and them getting a benefit from the investment. But if you're dealing with third parties, Even as you see on the slide, aunts, uncles, cousins, and siblings are not disqualified persons. If you're dealing with those individuals or any third party, obviously there's a lot of different things you can do, whether it's real estate or other types of assets as well. A couple of examples, again, of things that would be prohibited. If your IRA wants to buy a piece of property from your son, since your son's disqualified, that transaction's disqualified. Your IRA can't buy that property from him regardless of the terms involved. It's strict prohibition. Same thing with your IRA leasing property to your daughter. Again, she's a tenant. Your IRA is acting as a landlord. We kind of have a situation where you get parties on either side of the transaction. You have the IRA on one side and a disqualified person on the other. That's what makes the transaction prohibited. So if you're considering an investment and you have a disqualified person who may be connected to it, try to figure out, and that's something we can help you do, what side of the equation does the disqualified person sit on? Are they sitting on the same side as your IRA, as both buyers, or is it on an antagonistic side where your IRA is on one side, disqualified person's on the other? That's the situation, as you can see in these examples, when it becomes prohibited. Again, IRA buying property from your son as the seller, buy, sell, opposite sides. Landlord-tenant in a lease situation, or your father's IRA lending money to you or your son. Your father's IRA is the lender, you or your son are the borrower. Again, opposite sides of a transaction. That's what's prohibited inside under IRS particular rules. So kind of in a limited time, I thought I'd go through some of that information relatively.
Sorry,
You have a question?
I had a question, right? So yeah, the question is that can we mix because for an investment we might need a huge amount of money, right? Can I mix like, for example, 50K comes from my IRA and 50K comes from my own saving, and can I work that out in terms of investment?
You can. And actually, one of the little case studies I have here kind of touches on that with a husband and wife situation. But you could use both some IRA funds and some personal funds as both, say, buyers from a seller in a transaction. Your IRA and then you personally will just split the income and expenses for that investment. So depending on whatever percentage ownership is set at the forefront, you could certainly do that. We've had clients that have done that type of transaction.
Does that become like two different entities in terms of like tax implication, or even splitting the profit that comes out of it, or like, I mean, how would, because I would have to, whatever I earn from that IRA investment, my assumption is that it goes back to the IRA, right, when there's a distribution.
That is correct. So if you partner with your IRA, so your IRA owns 50% and you own 50%, the 50% going back to your IRA, not taxable to you at all, not reportable, not taxable to you. Your personal portion, though, would then fall on your particular tax schedule. So that would be, so you're going to have tax consequences as an individual, but whatever goes back to the IRA does not.
That means whatever restriction we saw there earlier should not apply to the 50% that I contributed from my savings, right?
Correct, because again, in the examples I did, let me just bump back a slide here. The examples are where your IRA is on the opposite side of the deal. Of these individuals, that's what's prohibited. But if you and your IRA together are both buyers, you're sitting on the same side of that transaction from some third party as a seller, that's permissible to do. The only thing is, once you buy that property, say 50-50 between you and your IRA, you could never have your IRA buy you out or vice versa, because now that would involve your IRA buying or selling with you on that particular property. But as long as you're always on the same side of the transaction, you can make that investment both personally and with the IRA.
You use the phrase partner with your IRA. Is it actually a implicit partnership, or are they just two different entities?
It is two different entities. That's an important distinction too. The IRA is the IRS considers the IRA its own legal entity. So it is a separate entity. If you buy a real estate together, it could be done as simply tenants in common on the deed, where your IRA is one entity and you are the other entity. I've also seen individuals form like an LLC or a limited partnership as well, where the IRA and them as an individual are both listed as, owners or members in that entity that may then buy the property. So but yeah, that is a good important distinction. The IRA and you are separate. All right, so the case study I was going to go through, I'm going to kind of take this one individual and go through 3 different types of investments that he might make inside the IRA account. All of them involve, John has money in his IRA account, wants to buy real estate, knows that there's numerous avenues he could go down. Again, when you invest through the IRA, kind of the 4th bullet point there on the slide, and we just talked about it in the question, if your IRA makes an investment, any income derived from that investment must go back into the IRA account, and any expense related to that investment gets paid out of the IRA as well. So in the case where John just buys a piece of real estate, all of the rent is going to come back to the IRA, and all expenses are going to be paid by the IRA as well. So the net then that stays in the account is going to be the gain to his account. Now, again, the question we just had, if you're partnering with yourself, the IRA is going to only receive its percentage of income. So if you kind of think of the IRA truly as that separate entity, separate partner, then it makes more sense that they're going to split that income. Kind of what we do at Advanta is we make sure that the properties get titled properly, and then we acting as the administrator will receive and deposit rents into the account and then pay any bills at the direction. So this first case study is just either a rental or rehab property. John using going to open up and fund an account. Again, that transfer or rollover from an existing IRA is tax-free. Then its key thing is when you go to buy property inside of your IRA account, that you make sure that the contract and then ultimately all the closing documents are put in the name of the IRA account itself. So one of the roles, again, we do at Advanta is to make sure that that wording does appear not only on the contract but on all the closing documents. That's what demonstrates to the IRS that when you've made this investment with your IRA, this is why it's not a distribution from your account and taxable. And that's why any income you receive is not taxable to you, because this is all an investment made underneath your IRA account. Just as if you were buying a mutual fund or stock, same thing, it's just a different type of asset. So again, we make sure that the documents for the closing get put in the name of the IRA, and also the client will review and approve all of the closing documents as well. So when you're investing with your IRA, you're involved every step of the way as well, reviewing the documents, making sure they're correct, and initialing off on them. We're not going to, no self-directed company will independently go and buy a piece of real estate without you giving them explicit instructions on what you're buying, how much you're paying, and getting your approval on the documents as well. So a representative of the IRA ultimately signs all of the closing documents. So the settlement statements, any other closing documents that the title company or attorney has are signed by the IRA custodian, and we wire funds out of the account to that particular closing. So we would have gotten funds transferred in, say from Schwab or Fidelity, into John's account. It sits in cash. Once the closing is about to happen, we wire money out of the account to complete that. And then going forward, John gets a tenant. All of the income flows back to the account. We deposit that, and then we pay any expenses as well. The taxes, the maintenance, the insurance, any expense related to that property. If his IRA owns 100%, his IRA needs to pay that expense. So if you're looking at self-directing, you need to make sure you have enough money in the account to acquire the asset. And then also, if there's going to be any expenses up front, you have enough kind of buffer or cushion there to pay that expense as well. And then, if he decides he could sell this property after he's fixed it up and just, have a quick rehab and get the profits back in his account. If he's renting it, all the rents can just simply accrue. We have clients who've owned property with us since 2004 when we started that still have the same property today. They've just continued to churn, monthly rental income over that time period back to the IRA. They're really unaffected by the peaks and valleys we've had in the market over the last decade or so. So again, this is one option of just John using his own IRA to buy his own property. No partners involved. It's 100% IRA, just paying cash for a particular deal. Any questions on that case study? All right, so we'll jump into the second one. And we've already touched on this a little bit. So the question that came up earlier was, can I use my IRA and my personal funds together as a partner? And that's what and I said you could, as long as you do it right. In this particular example, shows I have John and Linda. They could be husband, wife, could just be friends, whatever, doesn't matter. But they have their funds in their IRA account. They both have 150 grand, but the property that they're looking at buying is more than either one of them has in their account, and they're obviously going to need some more money to get this property fixed up and rent ready. So here's a situation where John and Linda can use both of their IRA accounts to partner on this particular deal. And this example, for ease of the example, is a 50-50 proposition. They both have roughly the same amount in their account that they'll use towards that particular purchase. In reality, the percentage doesn't necessarily matter because it's going to be more dependent on how much each party contributes to the overall investment as a whole. So the income, once this property is purchased, gets split between the two, and expenses get split as well. And again, you can replace John's IRA. You could replace Linda's IRA with John's personal funds, or John's father's IRA, or John's father's funds. In a partnering arrangement with a property where it's going to be bought as tenants in common, the IRA can own an interest and a disqualified person can own an interest as long as the purchase is done at that initial time. So if they're buying this property from a third party, they both have to buy their interest roughly at the same time. So it's a 50-50 proposition. Again, the percentage ownership is based on how much comes from each IRA account. No more, no less. And again, if they are disqualified people, again, if you're partnering with a spouse or you're partnering with your own personal funds, you cannot change those percentages or basically sell to each other down the road. That's the one caveat when you partner with yourself or with someone else who's disqualified, is you're going to lock that percentage ownership in up front at the time of closing. The last case that I want to hit on, again, I'm happy to answer any questions and stay on for as long as you'll have me, but
I have one question with respect
sure.
to, I mean, like you on the previous example, you showed that there is a net positive cash flow, right? But what about like if I have a negative cash flow? I mean, I purchased a townhouse. It's not giving me a positive cash flow. I'm on negative, but I might get a lot more value because of appreciation in future. So what happens in that case? Where does the money, for negative cash flow, where does the money come from? Does it come from my pocket, or how to handle such a situation?
Yeah, great question. So if you're going to have a situation where you have either negative cash flow or just no cash flow coming back in, you're going to want to make sure you have enough of a buffer or cushion in your IRA accounts to cover those expenses. So if I buy a property in my IRA today for, say, $100,000, and I know that I'm going to have $1,000 of expenses every month, and I'm not going to be able to sell it for a year, then I need to have not only $100,000 for the purchase, but I need to have that extra $12,000 or $13,000 available in my account to pay those expenses until I'm able to sell the property. There's no rule that says my property has to cash flow or positive cash flow. So the fact that I'm buying a property and then spending even more money before I ultimately get paid when it sells, that doesn't violate any rules. But again, if your IRA is buying the property, any expenses before the property is sold need to be paid by the account. So that's kind of where some planning up front comes into play to make sure you have enough cash in the account to not only buy the property, but then cover it and cover any negative cash flow while the IRA holds the property.
Do you want to talk for a moment to what happens if you don't have enough cash in your account?
Sure, I can. It's one of two things. So or a couple things, I guess. If you have, let's say you have your IRA with Advanta and you moved $110,000 over from Schwab, and you run out of cash in your Advanta account, but you still have other cash at Schwab, you can always do a second or third transfer, or fourth transfer even, from those other accounts. If you have money in other IRAs, you could always move that over to cover the cost. If that's not an option, if your only IRA you have is what's in the self-directed account, you could always make an annual contribution subject to the annual limits, which for a traditional Roth IRA is only $6,000 or $7,000 a year. So again, that may not be a big help depending on what the cost involved is. Another option is bringing in another partner. So if you bought the property 100% in the IRA, you're struggling, you're running out of cash, you sell a portion of that property to somebody else, and they put, basically the cash they pay for, say, a 20% ownership goes back into your IRA account and can be used for future expenses. It is possible to borrow against the property. So again, if you own the IRA outright 100%, you own the property inside the account, and you want to get kind of a refi or cash out, it may be possible. There are lenders who will lend to IRA accounts. There are not a lot of them, because you're not allowed to personally guarantee the loan. Means most lenders will not lend to the IRA account. The other thing I think would be difficult, and that's in this particular scenario, is if you're not cash flowing on the property, the lenders that lend to IRAs generally will not lend unless they see a positive cash flow. So you can always move more money from another account, make a contribution, or bring in another partner. But again, that's kind of where, depending on how easy or difficult it is for you to do, it's kind of where some of the planning comes in up front.
I guess the other option you didn't quite cover, but you came pretty close on, is hard money loans. There are hard money lenders that will lend to you. Of course, then you get into UBIT tax issues and other stuff like that.
You do, yeah. So if your IRA were to borrow the money from a hard money lender, then any future income that the IRA receives while there is leverage in place is subject to what they call UBIT tax, unrelated business income tax, and kind of a very short explanation of how that tax would apply. Let's say that I buy the property, then I get a refi out, and the property, I get a loan for 60% of the value of the property. So I get quite a bit of cash out of it. Any income that I then receive at that point, 60% of the income, the amount related to the leveraged proportion of the property, 60% of that income would actually be subject to what's called unrelated business income tax. So if your IRA buys a property for cash and receives cash flow, you never have to worry about that tax. But if your IRA has leverage on a piece of real estate, the IRS will tax the IRA for the percentage of income that the IRA receives in relation to the percentage of overall financing. So again, if you have a loan that's 60% of the value of the property, then 60% of the income the IRA receives is subject to that tax. The other 40% of the income comes back into the IRA with no tax consequence, but the other 60% would be. So again, that's another consideration if you're looking to do a hard money loan, either after you've acquired a property or even to acquire a property. You have to look at the impact that UBIT tax might have. And again, that tax applies to the IRA, not to you as an individual. So it's a tax the IRA itself will ultimately be responsible for. And the IRA files Form 990T in order to basically report that tax to the IRS and make the payments.
Right.
Hey, Scott.
The only reason I brought that up was just because there are options if you run out of money in your IRA. They're not all pretty, and some of them are more complex than you might like, but you can work your way out of a problem if you get stuck.
You can, and like I said, for instance, if it were me, I'd have no problem maybe finding a friend or a fellow investor to join my project. Other people, though, like you said, they have, that's not an option for me. I don't want to have a partner. I'd rather borrow the money and deal with UBIT than sell a portion of the property. So it is different, obviously different for other individuals, but that is certainly an option. Again, like I said, although it may not be the prettiest option or the most ideal.
Is there a 60-day rollover window for putting that money back into the IRA? So how could that be used in an advantage here?
The 60-day rollover really is just for moving money between IRA accounts. I don't know that would be able to be an example here, because the 60-day rollover only applies when you've taken a distribution from your IRA account or a 401k. You have 60 days to get that money back into another IRA account to avoid it being taxable to you. But that money, when it comes out of the account, is yours to use however you wish, and you can only put back in up to the amount you've taken out. So I don't think the 60-day rollover rule would help you at all if you're running out of cash inside the investment itself.
Gotcha.
All right, so just move on to do the case study. So keep the questions coming. They're good, so that helps feed the presentation.
Hey, Scott, I have one before you start this case study. So can you use your IRA to put the down payment on a property that you're going to mortgage?
You can. Yeah, it's similar to if you bought the property 100% and then get a finance out later, in the sense that UBIT is going to apply the same way. So if your IRA makes a down payment of 20 or 30%, and then you get a mortgage for the purchase up front, again, the qualifications for borrowing money inside the IRA account are that you cannot personally guarantee that loan. It's got to be a non-recourse loan from the lender to your IRA account. Without your personal guarantee, most banks won't touch it. Again, the ones that do are usually looking for probably 30 to 40% down on an income-producing property. But then again, you're going to have the UBIT tax consideration. But it certainly, again, it's not illegal, and that's where some people get confused with the prohibited transactions, things that are not allowed to do, as opposed to UBIT, which is you're certainly allowed to borrow money inside the IRA to buy a property. You're just going to have the implication of UBIT tax against the income that the IRA earns. Like I said, then the lenders that you're looking at are usually looking for probably 30 to 40% down. All right, the last case study I'll go to, like I said, I'm happy to answer more questions as we go. So the previous examples are where John, or in the case of John and Linda, buying a piece of real estate, the actual hard asset inside the account, that they're going to be responsible for making sure the rehab is done right, choosing their vendors, dealing with their tenants, etc. There are a lot of individuals who are real estate investors that have no interest at all in ever owning the actual real estate, but are more than happy to provide the financing for deals. They're your private lenders, the people who are the money guys, the money girls who have the money in the account. They're happy to lend it to someone who's doing a rehab, who's buying a rental, but they don't have no interest in actually owning the property. And so in this example, we have Andrea, who has money in an IRA, and she meets Steve, who wants to buy a property to flip. Basically get money from Andrea to purchase a property, fix it up, sell it. Again, when you're buying real estate, I don't know that it's as important you don't have to do due diligence on the seller of a piece of real estate. You're more concerned with making sure title is clear, you've had an inspection of the property, etc. But in this case, Andrea is lending money to Steve. She's going to want to do due diligence, probably on Steve particularly, for his character, his background, to make sure he's a good guy and upstanding, and then also on the property that he's going to use as collateral. If he's saying, "Hey, Andrea, give me $100,000, I can buy this property, flip it, make a good deal of profit." Is Steve selling her, down the river? Or is this actual, good, solid deal? So again, Andrea's responsibility in the situation to do that due diligence, and she offers to lend him that money. What's neat to me, as long as I've been in the industry, I think, is if you're looking to do private lending from your IRA, you're sitting in that banker's chair. So you walk into a bank, I want to buy this property, here's what I'm looking for. The banker tells you how much they're willing to lend, what the interest rate's going to be, when the maturity date is, and giving you those different options. So when your IRA is the bank, you're that banker. You're sitting in that chair. That when someone like Steve says, "I want to borrow money from you for an investment," you can dictate to Steve, "Hey, here are my terms. I'll give you $100,000. Here's my interest rate. I want a percentage of your profits. And if you don't like it, then go find yourself another investor." So I think being the bank and doing a private loan kind of gives you a lot more power, and can be again a good passive, truly passive investment. So one of our clients who did this investment structured it. It's kind of a hard money loan, but she only charged 5% interest as opposed to the 13, 14% in points. But what she did, in addition to the 5% interest, is she asked Steve to give her IRA a third of the profits when he sells the property, so that her IRA, and she can now participate in the actual gains of what the project. She's just not going to get 10% or 12% for 3 or 6 months while he rehabs the property. She gets some skin in the game, a little more exciting deal, obviously a little riskier maybe, depending on how good a job Steve does. She may not get much return at all based on the profits if there aren't any. Andrea's attorney drafts the note and mortgage. Again, our role is to review those documents, make sure that they are properly titled, make sure she's approved of them, and ultimately fund that mortgage at closing. When Steve's ready to sell, he's going to request a payoff that Andrea will help provide. And in this example, if he makes a $30,000 profit on the sale of the house, her total return is 12.5. She gets 6 months of interest payments plus a third of those profits back in her account. So not a bad return at all in that particular deal. And even for Steve, if he put no money down, had no skin in the game up front, he still walks away with obviously earnings from that particular deal. And again, in this example, for ease of the example, he doesn't make a down payment or put any other money into the deal, but certainly Andrea could have required him to do so and say, hey, Steve, if I'm going to lend you $100,000, I want to see you put 50 grand of your own up first in this particular project. But again, for sake of example, we didn't do that. But these terms, the interest rate, the equity participation, again, are all within Andrea's discretion. The only thing that we typically would advise somebody looking to do private loans inside the IRA is make sure that the interest rate is kind of a market value. You don't want to have a 1% or 2% loan to a friend. That does not make investment sense. So your interest rate really should be a kind of market value, fair market transaction when it comes inside the IRA account. So yeah, I know Daniel, you gave me about 30 minutes. I've gone over quite a bit. I hope that's okay.
That's perfectly fine.
Yeah, and I'm more than happy to answer any other questions. I didn't discuss the Checkbook Control LLC for an IRA account. I'm happy to get into that if anyone has questions on that, or I can briefly describe it. But I'll wait and see kind of what questions you guys have.
Sure, and just for your information, our group actually ends at 1 p.m., so you've got 15 more minutes if you want it.
Okay, good. Well, yeah, I'm happy to answer any more questions. I guess I can briefly just tell you guys what the checkbook control. So if we think back to the example we had initially with John, and he's buying real estate, and I said, any expense from the property gets paid out of the IRA. Well, one of the roles we do have at Advanta is we would, John submits the invoice to us, and we cut the check out of the account to get it paid. Likewise with the income, the tenant sends the rent check directly to us. We deposit it, back into his IRA account. So we're kind of in control of all the funds. John is just directing all the activity. We've had clients, obviously, over the years buy properties at auctions, buy tax liens, other investments where they just want a greater degree of control. They want to be able to issue the check. They want to be able to simply deposit the income and not have to involve Advanta in every different transaction. Now, we don't charge anything extra for cutting those checks, but even still, some people want to have that greater flexibility. So back in 1996 is kind of the birth, I'd say maybe it started before then, but the first court case on it, the Checkbook IRA, essentially an entity where you set up a brand new structure. In most cases, it's done as an LLC, so you create a brand new LLC where the sole owner of that entity is your IRA account. And so your IRA, rather than buying different properties, you're directing Advanta, I want my IRA to buy 100% of the stock in this LLC and send all of my IRA cash into the bank account for the LLC. And you name yourself as manager of that LLC, which then gives you, in turn, control over the bank account. So rather than having Advanta or your self-directed custodian buy the property and then handle all the income and all the expenses and be involved, you direct your custodian to buy the stock in that LLC account. So your investment on your statement shows 100% ownership of ABC LLC. Now that cash is in the LLC bank account, you as the manager can go out and acquire the properties, the tax liens, buy things at auction in the name of the LLC. And then all of the income and expenses you can take care of by writing checks in and out of that LLC. And that's what they refer to as checkbook control for your IRA, or a checkbook IRA, because you now have much greater authority over those funds. And that, like I said, that was kind of solidified in a couple of court cases, one in 1996, the last more recently in 2013, where the IRS tax court has said that kind of structure, it's permissible for you as the IRA owner to be that manager. What's not allowed, though, is if you are acting in that role as manager with a checkbook structure, you should not be getting paid for that. You cannot pay yourself compensation take a salary, anything like that. It's got to be strictly arm's length. But again, that's a mechanism that people have used to acquire several different assets all under one umbrella, or buying properties, like I said, at auctions that are just easier to do when you have the ability to write that check. So again, not something I covered during this seminar. One thing I would mention, if you're looking for more information, all the different investments I talked about, we've done numerous educational webinars. We've had a lot of good guest speakers on as well. You can just go to our YouTube page. We've had attorneys, CPAs, real estate investment gurus on in the past that talk about different investment strategies. They're all on our website, just free of charge. Just go there and go to our YouTube page. You can click on a webinar and watch it. So we go in a deeper dive on the checkbook control, on the private lending, on the real estate as well. So this is a little bit higher level view. We got into some deeper topics. But like I said, I'm more than happy to answer the question. Sure.
I do too, when you're done.
So this is Richard McGrew. I've been around the self-directed IRA space quite a bit and talked with a lot of the custodian folks. And there's nobody I've ever met that's recommending investors use the checkbook control, especially in the last 5 years when there's been so many court cases and so many people lost their money.
Right.
Are you suggesting that folks here at Intel who are just learning about IRAs consider using a self-directed IRA?
Well, as far as using a self-directed IRA or the checkbook control specifically?
Checkbook control specifically.
Again, kind of our role, we do not suggest any particular strategy. At times we have people who it might make more sense for people. That doesn't mean if you want to buy a property at a tax lien or an auction, you don't have to have an LLC to do it. For somebody who's starting out, it may not be a good idea to do it right off the bat. Again, that's our role is not to tell somebody they should or shouldn't do it. That being said,
maybe we just talk for a second about the risks if they do use a checkbook control.
Oh, absolutely.
And make a mistake. If they make a mistake, the risks are extremely high.
Sure, yeah. I'll discuss. A quick point on that, though. I will say, I also have had many clients over the years who've bought property, say, in their IRA, and saw how Advanta did the record keeping, how we processed bills, got a great understanding of the rules, and then down the line, did transition to the LLC at a later date. So it's not, you don't have to choose up front, checkbook control or not. It is something you could work your way into. As you said, the question that's dangerous with an IRA in any regard, whether it's a checkbook control or not, if your IRA engages in a prohibited transaction, your IRA ceases to be an IRA the year that activity took place and is deemed immediately taxable to you in that particular year. So if it's 2019, let's say I started an investment 5 years ago, I was actually living in the property. It's prohibited, and the IRS catches wind of it 5 years later, they will make me go back and amend my tax return and claim that income, claim any early distribution penalties, any non-reporting of tax. They can seize up to 100% of your IRA account and take your entire IRA. So it's a very severe penalty if you get engaged in something that's prohibited. I think what you're alluding to in the question as well, with the checkbook IRA, it's that tool that gives you, for the right person, gives you that great freedom to be on your own, if that's what you crave and you know the rules and have a great understanding. But it's also something that can get you in a lot of trouble because you have that much freedom. You could inadvertently do something that's prohibited. So
thank you for that. I just wanted them to hear the downside, because a simple check written to your mom for gas money or something could blow up your IRA, right? So it's pretty bad.
Yeah, no, and I had a couple of years ago, I had a CPA call me once and said, you have a mutual client, I think we have a problem, which you never want to have your CPA call someone and say, I think we have a problem. But he'd done a checkbook control entity where he'd done a private loan to an individual from it. He had done a loan to his sister, which, again, she's technically not prohibited. But then he took a personal loan, and I don't think it was it wasn't him trying to get around the rules without anyone knowing. He simply forgot. And I think the ease of the checkbook LLC made it so, hey, I'll just write myself a check and I'll pay it back. What's the big deal? Well, the big deal is that's prohibited. He just invalidated his IRA. So again, the ease of that administration is what ended up kind of getting him in trouble. So again, that's the downside. The upside is, he had the freedom to make, quicker investments. But again, you got to balance those out depending on what you're doing.
Yeah, definitely when you're getting started, use the custodian. It's extremely painful. It takes forever to get a transaction done, but it's nice protection.
It is. I can tell you that we are at Advanta. I've processed investments in a day or two. If the funds are there, It's a matter of us just getting the paperwork done. So we do not have a lengthy review process. So we do try to make it as quick as possible. But somebody else mentioned, I think they had a question also.
Yeah, Scott, you mentioned all the way back at the very beginning that Advanta had almost $1 billion in funds that were being managed in self-directed IRAs, or that your clients do.
Correct.
I was wondering what is setting Advanta apart from a lot of the other IRA companies, self-directed companies that are out there. There, as you know, there are a lot of them out there. What's giving you that edge?
I think what our edge, I think what we've seen over the years, we've really focused strong on our customer service and kind of what I was just alluding to there with the speed of processing. Every new account gets appointed to an account manager here in our office who is your point of contact. Anything you need regarding your account, you have their name, you have their email address, their direct line. You're not waiting on hold to get the next person on the line. So it's been that customer service focus. Like I said, we limit how many accounts each account manager get. We don't even overload them. That, and I think our educational offerings. I think if you were to check out our on-demand site and just look at our all the YouTube recordings, a pretty good diversity of different people. Definitely some names that some of you may know on there from the national RIA groups and whatnot as well. We've had to bring speakers in, and it's not always a speaker on self-directed IRAs. Like, we're not bringing someone in just to say, hey, you got to only talk about self-directed IRAs. We've had people come in and talk about general real estate investing trends, IRA or not. Landlord-tenant law. That again doesn't have to be an IRA to be pertinent. So I think that's how we've set ourselves apart. Really, try the education we try to provide, the value in that, but then especially for our clients at least, the customer service. I can tell you that it's very rare that we transfer an account out to another custodian. Into another self-directed custodian, but we get several each month where somebody's coming from somewhere else to us.
Any other questions?
Like I said, just with the last slide, make sure he has my contact information. If you're with another custodian and you want a quick answer to a question, give me a call. I'm more than happy to answer it for you. You want to run an investment scenario by me. Hey, does this sound prohibited to you? What are the issues involved? I'm always available to run through those. I enjoy those discussions to kind of parse through the different avenues, the different risks that are involved. Again, the one thing that we just won't do if something falls in a gray area of IRS rules is give you kind of an answer one way or the other. Now, if it's strictly prohibited, you say, hey, I want to lend money to my mom, so you can't do that. There's no gray area under IRS rules. But some of the other things that trickle in where people have complicated scenarios, I'm always more than happy to discuss those with you and just go through that thought process. And I can always, like I said, refer you to people who can maybe give you a more definitive answer.
Well, Scott, thank you so much for coming in here and sharing with us and taking time out of your day to present your knowledge.
Oh, Daniel, thanks very much for having me on. I appreciate everybody's questions as well and participating. And like I said, my contact information's here. Just anytime, just shoot me an email. Say, I heard you on the Intel REI Club. I had a quick question, or shoot me an email, give me a call. I'll be happy to talk with you.
Okay. Thanks a lot.
Thank you.
All right. Thank you, guys.
And just for people that are on the line, what are your feelings about having another meeting next week? My feelings are that we're going to be missing a lot of people, but if people want to do it, we can do it. I do actually have a guest lined up. Does anybody have strong opinions one way or another?
I'm enjoying them, but I'm on the East Coast, and it's very helpful.
Okay. I know that I always feel a little guilty when I bring a guest speaker in and we don't have a lot of people, so I'm sensitive to that. Was somebody else going to speak?
I think most people will have to be around after that. And a lot of people will be at.
Yeah,
okay.
This next week should be fine.
Next week is fine?
Yeah.
Next week is fine.
Probably,
yeah, the 27th, I've actually already canceled the person who originally signed up to take that slot. I should not have sent out a calendar that had that slot. All right. Well, we'll see you all next week.
Thank you very much.
Thank you.
Bye.
Bye-bye.